Why isn't money management taught in schools? How many of you in high school truly learned how your credit score is calculated? How many of you practically saw how compound interest could work to get you out of debt or make you wealthy, or even knew what a W-2 form, tax form was? Instead, we learned how to calculate the hypotenuse of a triangle, the respiratory chain of the mitochondria, and the dynastic wars in the 18th century Europe. Vital knowledge, sure, but which of those subjects actually helped you make a living, get out of debt, and make money while you sleep for your future? We know the answer, don't we? None of them. Financial illiteracy is the biggest and most costly gap in the modern world. We graduate, we have a diploma in hand, but we feel like an idiot when we walk into a bank. Today, we won't just criticize this situation. We will cover the 4 shocking reasons behind this scandal, the 3 devastating costs of financial ignorance, and most importantly, the 5 concrete lessons you must teach yourself. By the time this video is over, you will realize that you won't leave your financial education in anyone else's hands. Hit that subscribe button right now, because on this channel we will learn everything that wasn't taught in school. Let's get started. In section 1, the system's big mistake. Why was this knowledge hidden? This isn't a personal failure, it's a systemic flaw. Here are 4 powerful reasons why money management remains outside the curriculum. 1.1. The industrial age legacy, raising obedient employees. Our education system is shaped by the needs of the 19th century to produce perfect employees for factories and hierarchical corporations. In this model, the system expects you to obey an authority, employer/state, that tells you what to do, gives you a paycheck, and organizes your life. Financial literacy does the exact opposite. It gives the individual the skills for independence and self-management. When a person learns money management, they're no longer so dependent on their next paycheck and job. They begin to set their own rules. Historically, the education system has preferred to raise individuals who serve the system, not those who break away from it. 1.2. Consumption capitalism and the indebtedness machine. This is perhaps the most unsettling reason. A financially illiterate society is prone to constant borrowing and perpetual consumption. A young person who doesn't know the interest rates on a credit card is more likely to fall into the debt trap. They think taking out a high-interest loan for a luxury item that is losing value is normal. Major banks earn billions from high-interest consumer loans and massive credit card debt. The less you know about finance, the more banks and large corporations earn. Is it a coincidence that the system removes a lesson that produces the most loyal and profitable customers from the curriculum? I want you to think about that. 1.3. Lack of standardization and assessment. Education demands standardized tests and measurable results. Math is easy. There are right and wrong answers. History is easy. There are dates and events. But what about money management? It's a life philosophy. There is no single correct answer to a question like, should I buy an index fund or real estate? The fact that the subject is constantly changing, cryptocurrencies, new tax laws, and controversial makes it impossible to create a curriculum and standardize student assessment. For convenience, the subject is completely left out. 1.4. The lack of qualified teachers themselves. Most teachers are not trained as personal finance experts. They are experts in history, literature, or mathematics. How convincingly can a teacher teach someone the ways to become a millionaire when they themselves are struggling to make ends meet or are dealing with debt? Training them to use financial tools poses a major logistical and ethical challenge for teacher unions and school administrations. Section 2. The 3 devastating costs of financial ignorance. The cost of lacking financial knowledge isn't just a zero balance in our bank account. The impact goes much deeper. 2.1. The cancellation of early retirement dreams. Someone who doesn't learn the power of compound interest in school thinks they are safe by keeping their money in the bank. However, this is handing over money to inflation. If a person starts investing $200 a month at age 25, they will be much wealthier at age 45 than someone who starts with $500 a month at age 35, because time is more important than money. This lack of knowledge sets us back years and kills the dreams of early retirement. 2.2. Relationship strain and mental health issues. Money is the number one cause of divorce and relationship tension. When one partner doesn't know how to budget and the other deals with secret debt, trust is eroded. Financial stress leads to sleep disorders, anxiety, and a constant survival mode. Unfortunately, those small lessons we didn't learn become giant burdens that reduce the quality of our lives and the quality of our relationships. 2.3. The paycheck-to-paycheck cycle, the rat race. If we don't learn to see budgeting as a map to freedom rather than a restriction, we panic at the end of every month, no matter how much we earn. We fall into the lifestyle creep trap. Income increases, but spending automatically increases too. The result? We experience the same stress earning $100,000 that we did earning $50,000. This cycle enslaves us to the next paycheck. Section 3. Your own financial rescue curriculum. 5 essential lessons. We've blamed the system. Now let's focus on the solution. Here are 5 fundamental lessons that no one taught you, but you must learn. Lesson 1. The debt fighting strategy, the debt snowball. You need a strategy to eliminate your bad debts, credit cards, personal loans. Step 1. List all your debts from the smallest amount to the largest. Step 2. Focus on the smallest debt and pay it off as quickly as possible. Make only the minimum payments on the others. Step 3. When the smallest debt is paid off, take the money you were paying for that debt and add it to the next debt on the list. This way, your payment power increases with every debt eliminated, growing like a snowball and quickly crushing all your debts. This is a psychological game. Small victories give you motivation to continue. Lesson 2. Credit score hacking. Your credit score doesn't just determine whether you can borrow money. It also affects your insurance rates, your ability to rent an apartment, and even your chances of being hired for some jobs. The main rule: keep your debt to limit ratio low, preferably below 30%. Payment history. Never miss a payment. Payment history is the biggest piece of your score. Age. The length of your credit history matters. Use your credit card for years and don't cancel it. These 3 simple rules are the financial superpower no one told you about. Lesson 3. The 48-hour rule and the spending pause. Impulse purchases are the killer of our budget. When you see something and feel the urge to buy it now, stop. Add the product to your online cart or leave it in the store. Wait 48 hours. During this time, ask yourself, does this meet a real need, or is it just a fleeting emotional gratification? Most of the time, the excitement for that product will fade after 48 hours, and your money will stay in your pocket. Lesson 4. Open 2 types of money accounts. We must automate financial discipline. Account 1, daily, your main paycheck account. Use it for daily expenses and bills. Account 2, inaccessible. Open it at a different bank or in a separate investment account. This is for your emergency fund and your investment fund. The rule: on the day your paycheck lands, automatically transfer a set percentage, at least 10%, to the second account. If you never see this money, your brain is forced to spend according to the remaining budget. That's the whole magic. Lesson 5. Good debt, bad debt, smart debt. Bad debt, high interest credit cards, payday loans. Kill these. Good debt, low interest borrowing for an asset that will increase in value. A reasonable mortgage for a house. Education that gives you a new skill. Use these wisely. Smart debt, consolidating one debt with a new, lower interest debt consolidation. This gives you breathing room. Section 4. The meaning of freedom. Financial literacy isn't just about knowing the numbers, it's a mindset. Remember, financial freedom isn't a luxury car or an expensive watch. Financial freedom is the freedom of choice. Not having to stay in a job you hate. Not panicking when you get sick or lose your job. Being able to choose the best education for your children. Being able to do a job you are passionate about, not just to make money, but because you truly want to. The system didn't teach us, but now we know that we are the sole masters of our financial destiny. This knowledge is now in your hands. Friends, by watching this video today, you have taken the most important step on your financial awakening journey. Now it's time to act. I want a single promise from you. Share the first concrete step you will implement after this video in the comments. Will it be, I will set up my emergency fund, or I will crush my credit card debt with the debt snowball method? I'm waiting for your promises in the comments. Let's support each other in this community. If this content empowered you, please hit the like button and share this information with every friend who needs it. See you in the next financial freedom lesson. Take care of yourself and your money.